You know that feeling when someone shows up for you just when you need it most? That's what Uber is all about. Not just a ride or dinner at your door. It's how Uber helps you show up for the moments that matter. Because showing up can turn a tough day around or make a good one even better. Whatever it is, big or small, Uber is on the way. So you can be on yours. Uber, on our way.
Reality radio for a really great future. We're talking real money.
Hey, everybody. Welcome to the Q&A edition. It's a Friday. When I put this up anyway, that's when it's a Friday. Can not be a Friday when you're listening. I don't know what day it is, but thanks for listening. I am in my hermetically sealed voiceover booth today because my main office monitor is in getting some changes made to it to put it on an arm. So I'm in the studio. I'm in the box and different mic. So it may sound a little different. This is my voiceover mic. And thanks for all the questions you guys have been sending in. Just tons of them have come in lately, and just keep them coming because that allows us to do longer Q&A shows like today's. We're going to have a record number of questions and comments in today's episode. A quick little note, just because I like to keep you informed about what's going on in life. If you listen to the podcast regularly, you may have heard that I was going in for surgery on Friday. I did go in for surgery on Friday. It didn't work out the way we had all hoped. It was an ablation surgery, which is where they're going to zap your heart so you don't have AFib, which I have a gene for. And they couldn't do it because of another issue that, anyway, it's very complicated. I was under the anesthesia and then out. They said, nope, can't do it, can't operate on you. So just wanted to keep you informed of what's going on, and thanks for all the concern and all the nice thoughts that people shared. And let's do some questions, shall we? These all came in from talkingrealmoney.com by folks who hit the contact button and then recorded the question using their phone microphone or their computer microphone, or hopefully even one of those good microphones that you buy and add on to your computer. You know, I'm getting a new one. A USB mic. I should do a review of it. I don't know. I'm not sure I'm going to like it yet. I haven't gotten it yet, but if I do, it looks like a great little USB mic for traveling. Anyway, let's go to the first question.
Hi, Tom and Don. I have a question about simple IRAs. I'm actually calling from my daughter. She works for a small nonprofit back in North Carolina, and they have a simple IRA option that she's participating in, and it has a 3% match, which is good, free money, yay. But we found out recently that there's a 5% fee on each transaction. So when she makes her contribution, 5% comes off of that. And when the company puts in their contribution, 5% comes off of that. The broker is Raymond James, and they use the Capital Fund Group and American Funds, and it's currently invested in a target date fund, a 2060, I believe, target date fund. But my question is about those fees. She actually called them, and they said that's customary and normal. It seems rather high to me. I'm not sure if there's any options for her to get out of that 5% fee. Again, it's free money, so we're probably stuck with that. But I just wanted to check with you. One thought that I had is just minimize the amount, just do the 3% and no more, and then start a separate IRA. And that way she could at least save the 5% on any additional money. So wondered your thoughts on that. And then also, if she did do a separate IRA, is the maximum amount that she can take or put into the IRA the sum of that 3% match plus if she were to do a separate IRA? Does she have to add those two together to the maximum, or can she do a full max on that separate IRA? And then, finally, would you recommend AVGE plus a bond fund? And what percentages do you think that she would be good for someone her age who's 30 plus years away from retirement? Thank you very much.
There's a bunch of stuff in there. We're going to start with what I see as the obvious problem. Whoever is heading up this nonprofit apparently has a relationship with this person at Raymond James. That's usually how people get in with these people. It's through some affiliation at a church, through the nonprofit organization. They may sit on the board, and so they're helping enrich this commissioned salesperson, which is what this is. This is a commissioned salesperson. This is not someone who has a fiduciary duty to the members of this simple IRA, to the participants, the investors. They can't charge a commission if they're acting as a fiduciary, because there are non-commission products that will do as well, maybe even better. So the first thing, I don't know what her relationship is with the head of this organization or the trustees or whomever made this decision, but that's where I would start. I would say, do you realize all of us, just by simply going to Vanguard or Fidelity or Schwab or whomever and setting up a self-directed account, can get into funds like the Vanguard funds or the Avantis funds or the Dimensional funds or whatever they might be, and get into them at zero load, zero commission, and probably, in fact, I'm confident, at a much lower annual expense too, because I know the American funds, and those are 60, 70, 80 basis point funds, whereas some of the Vanguard ETFs out there are, 5/10 of or 5/100ths of 1%, and the Avantis and the Dimensional stuff is 2/10, 3/10. So across the board, it's going to be a better deal if she can get them to change. It's better for everybody involved except the Raymond James broker. That's the only person who's going to suffer if they change. Now, the simple IRA is a different beast than the regular IRA. You have different contribution limits for each of those. So if you're under 50, which she is, she can contribute in addition to this IRA at work, this simple. She can contribute $7,000 a year to her own, probably Roth, I would suggest. Roth. She's with a nonprofit. I'm pretty sure she isn't making big bucks. She's not in a high bracket. So what you could do is get the match, because you want the free money, although you're losing a bunch of that free money to the commission, still get the match and then do the $7,000 a year in a Roth IRA using something like AVGE, which, as long as she understands the incredible volatility of that fund potentially, it's going to be way up, way down. But remember, if it's way down and you're building wealth, that's a good thing. You want your investments to be low when you're buying them and high when you're getting out of them. So I think you know what you should do. You know what she should do. But the first thing I would do is talk to that employer and see if you can talk them into changing. Maybe you can talk them into calling us, and we'll help convince them. Because this Raymond James person isn't going to do that. This is a very lucrative account for that person. They make a bunch of their living off of these people. And why should they? Are they getting something special for their 5%? My guess is probably not. If you have a question, just go to talkingrealmoney.com. If you want to talk directly to us, though, and have a conversation, well, that's really easy, too. Every Saturday from 3 to 5 Eastern Time, just call 855-935-TALK, 855-935-8255, and we can have a conversation on our radio show that becomes a podcast the next week. So easy. TalkingRealMoney.com or call 855-935-TALK, and let's grab another one of our questions.
Hey guys, had a question for you about Social Security. I've heard you say that it takes 10 years to break even if you take it at 70 instead of 62. recently a friend said he's going to take his next year when he's 65 because he would not break even until he hit 84. That doesn't sound right. Is that right?
No, there isn't a 10-year break even. That's not the case. The break even varies. It generally runs in the teen years, about teens to no, in the teens. And so I ran a scenario with a $3,000 full retirement age benefit and looking at taking it earlier at 65, taking it almost 2 years earlier at 65 versus taking it at 70. And the break-even point for that person, that hypothetical person, and it varies from person to person, would have been 81 years old. So if you die before 81, it's better to take it early. If you think you're going to die after 81, it's better to wait until 70. So you see the problem? Generally speaking, it's better to wait at least until full retirement age because you're truly leaving money on the table unless there's a reason why you need to take it early or you truly believe you're not going to make it past your early 80s. That's where the break-evens usually occur somewhere in there. So, no, it's not. There's not a rule of thumb, but there are tons of break-even calculators online that you can run and see what the scenario looks like for you. Thanks so much for the question. I appreciate it. Let's go grab another.
Hi, Don and Tom. David from Wisconsin. I just opened a new Roth with Robinhood to take advantage of the 3% bonus. I also want to take advantage of their bonus for transferring an existing Roth. The Roth I plan to transfer is past the 5-year rule. If I move it, do those funds reset the years based on the new Robinhood account? Being that I'm 57, I'm not sure if the bonus is worth the effort if the 5-year rule is reset. Love to hear your thoughts. Thanks.
The 5-year rule is not reset. The 5-year rule states that if you put new money into a Roth, you can't take it out for 5 years. It also applies to converting a traditional IRA to a Roth, but it doesn't apply to a transfer from a Roth to a Roth. If the Roth is already over 5 years old and you move it to a different Roth, it's still in a Roth, so it's still over 5 years old. So no, it does not apply. So therefore, the bonus, my understanding is, I don't know all the rules and regs of the bonus, but that it sounds like it's probably going to be worthwhile, at least from that standpoint. So nope, don't have to worry about that clock resetting. It doesn't reset. New contributions? Yes. Old ones? No. Thanks for the question. You can send your question in at talkingrealmoney.com. You can type it or you can speak it. Speak it gets you on the Friday podcasts. You can also call us on our show on Saturdays in Seattle on Northwest News Radio at 855-935-8255, starting at 3 p.m. Eastern. I think we have another question. I know we have another question because we've got a bunch.
Hey, Don and Tom. To start off, thanks for all the information that you guys provided over the years. Hopefully you can help me with this bit of fact-finding. I know that you guys have covered this, but I'm hoping that you can group all the information that I'm asking for into one response here. So what questions should I ask someone that I'm looking to hire as a financial advisor? Thanks for all the information and help you guys have provided, and I'll be listening to you for more in the future.
Well, the trick is to ask probative questions, but remembering that sometimes people lie. I mean, for example, the first question you should always ask as an advisor is, are you always required to act as my fiduciary at all times in all transactions? Now, a lot of them are going to lie about that one. They're going to lie. How are you paid? If they say you pay me a fee, what's the fee? That's likely a fiduciary advisor, but you need to add this next question. Do you ever receive a commission for any product that I might use in my portfolio? Ever? Again, there's another one to which they sometimes lie in some parts of the industry. If you'd like this all in a really, as you said, you want it in one format, go to talkingrealmoney.com/help and download the advisor interview form. You can give that to an advisor and ask them to fill it out, or you can just use it as prompts to ask questions and get their answers. It's really helpful, but there are things you should do that we don't like doing. One of those, I think, is at least skimming any advisor's Form ADV Part 2, which is available at advisorinfo, ADVISER info, at .sec.gov, advisorinfo.sec.gov, and look for, just skim through it. It's a PDF. Search it. Search for fees. Search for conflicts of interest. Search for commissions. That's going to tell you a lot, those paragraphs about those things. One of the first things you should look at is the size. If it's dozens of pages, okay. If it's less than dozens, that's even better. If it's hundreds of pages, they generally have a lot to hide. So I'd skip the long ones. But go to talkingrealmoney.com/help and download that advisor interview form. It's hopefully helpful. And now we have another question for you to listen to.
I was wondering if you could explain to me what the difference is between makes a stock a value stock, and why are small cap value stocks more valuable than mid and large cap value stocks? Thank you.
Well, first, it's not that one type of stock, one equity asset class is more valuable than the other. It's the expectations from them based on past research into their performance. And what the data from the past 100 years or so has shown, or less in some cases, is that small company value stocks have tended over long periods of time to perform better than larger company, more growth-oriented stocks. How those are defined, a small company stock is based on the size of the market capitalization of the company. How many shares outstanding times the price of the stock. A value stock, the value stock category is primarily based on asset values. A company is worth more liquidated than it is currently in the stock market, and that usually denotes a company that is out of favor with the market right now. And so its price is very low, but its asset value, its breakup value, may be a lot higher. So they're not exact terms, they're squishy. They're squishy. And the reason for the higher return for smaller companies and value companies is really simple. It's all a matter of risk. As an investor, you expect greater rewards from stocks that are more risky, more volatile, that might fail. A company that is doing badly, again, may have a high asset value, but they're not making much money, so they could go bankrupt. A company that's very small might not make it. So you're being rewarded as an investor for taking risks. And we believe that if you do them in a well-diversified manner, if you do them in aggregate, that you mitigate a lot of that forever risk and you replace it with merely volatility, which the data from the past shows has tended to work out. There is absolutely nothing exact about this process. It's pretty subjective. Thanks for your question. And I think the next one, it's a comment.
Hello, Don. This is Jay from the Colony, Texas. You answered an audio question for me about how they determine the average return for an ETF or mutual fund, and you indicated it was just math, which I appreciate the response. In my original audio, I'd said that I'd asked two other advisors and they kind of gave me smart aleck answers. Well, the first answer I got from an advisor, I believe I started my question with, If a prospectus says, and then I went on with my question, their response to me was, so you read a lot of prospectuses, huh? And then didn't answer the question. The second advisor asked the same question that I asked you. He basically said, no, it doesn't work like that. They don't know when you get in and out. Well, I know that. That wasn't my question. So I do appreciate your straightforward answer. Just getting back from a 2-week cruise, so lots of podcasts to listen to. Again, appreciate the work you and Tom do. Thank you. Bye now.
Thanks. Thanks for the comments. They don't want you to read the prospectuses. For heaven's sake, that's where all the truth lies. Don't read those darn prospectuses. And I don't know why they answer the way they do. I mean, I do. I really believe, I truly believe that the vast majority of the industry, the financial services advice providing industry, is highly incompetent when it comes to understanding the products. Oh, I think they're very good when it comes to selling things. And I believe that not just based on personal experience, but on interacting with many of you. I know the reason I was hired by Dean Witter back in what year was that anyway? 1983. Was because I was a good salesman. It wasn't because I knew a darn thing about money, because I didn't. I truly did not. I was forced to learn about it as I was one of the few brokers who made it out of the training group. But going in, I didn't know anything, but I was a very good salesman. Now, over the subsequent 40 plus years, I've learned a lot more about money and investing. Thanks for your call. I appreciate it. And let's wrap it up with the last question of the podcast.
Hey, Tom and Don. In a recent podcast, you had mentioned to your listeners about getting better exposure in international bond holdings, but didn't happen to mention any international index bond funds. I was wondering if you could make some suggestions in that regard for your listeners. That'd be very helpful. Currently, my primary holdings are in BND, so it'd be nice to know what your recommendations would be for some international bond exposure in an index fund. Thanks so much for what you do.
Boy, this is going to be a short answer. Really short answer. BNDX. BNDX. That is the Vanguard Total International Bond Index Fund. It's just like BND, except the number one holdings are France, Germany, United Kingdom, Italy, etc., instead of U.S. Treasuries. High quality, really, really good quality. It's investment grade pretty much across the board. Duration's a little bit longer than BND. They're longer term bonds, so there may be a little bit more volatility. But as far as funds go, it's as cheap as it can be. The yield's a little bit lower overseas than it is here, but that's diversification. I probably wouldn't put very much into it, but of all the funds out there, it's an ETF, by the way, BNDX. And of all of them out there, it's the cheapest I'm aware of, and it's massively diversified. So I think it probably will work well for pretty much everybody. Thanks for the question, and thank you all for all your questions, and keep asking them. Go to talkingrealmoney.com, type your question, or speak it using your device microphone. Or call us on Saturdays when we do our show together. We're going to be doing one soon. Well, we pretty much do one every Saturday. And that number is 855-935-TALK, 855-935, and then the talk parts is 8255. And call us starting at 3 p.m. Eastern, noon Pacific. The earlier you call, the more likely you are to get in. So call between 3 and 4, 3 to 5. 3 to 5, 855-935-TALK. Thanks so much for being a part of the podcast. I truly, truly appreciate you. Tell a friend or two or several hundred if you're at a big gathering. And don't forget, it's really important that we all are talking real money.
The opinions and views expressed on this podcast were current on the date recorded.
Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone.
This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction.
Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.